Welcome to Whitefield's 100th financial year results update. I'm Monica Knight and I'm here today with Chairman Angus Gluskie and Executive Director Will Seddon about the company's financial year results for the year ending March 2023. Whitefield was founded in March 1923 at a time where there were no other public investment funds. Today, it's Australia's longest operating ASX listed investment company and public investment fund. Angus, can you tell me about Whitefield's creation?
Sure. So the company was established by an energetic and business-minded individual called Alfred S. White. So he could see profitable opportunities for investment in the Australian economy in the booming 1920s, and could also see that investors needed to be able to access professional and cost-efficient management of those investments. So with those thoughts in mind, he launched Whitefield in 1923 with an initial issue of £5,000. And due to the success of that issue, it was followed up with a sequence of further issues, raising the company's capital above £300,000, which was a fairly significant sum in the next 5 years. The company first traded on an over-the-counter basis amongst stockbrokers until its formal listing on the Sydney Stock Exchange occurred in June 1928.
So the company's operated continuously since then, and profit in its 100th financial year rose to $18 million, an increase of over 7%.
Yes, the growth in earnings translated to a growth in earnings per ordinary share of 7.9% across that year. Positively, we did see the growth accelerate from the first half into the second half. First half growth was around 2%, second half growth around 14%. The growth in those underlying earnings was also evidenced by increases in dividends from the majority of the investment portfolio. And we saw notable increases come from not only the major banks, but also the energy and agricultural sectors, with companies such as Origin Energy, APA Group, Incitec, New Farm and Grain Corp showing good levels of dividend increase. And then we also saw growth from a number of companies operating well in their particular industry subsectors. So examples there included Hub24, Computershare, Transurban and WiseTech.
Whitefield's year-end dividend has been declared and remains at 10.25 cents per ordinary share and 131.25 cents per resettable preference share. These are fully franked and will be payable in June 2023. Whitefield has now maintained or increased its dividend for more than 30 years since the introduction of the dividend imputation scheme in the 1980s. Will the dividend be retained at this level again in 2024?
Yes, so at this stage we'd expect to keep our dividend at the same levels as we go through 2024. Encouragingly though, if we see a further year of income growth or growth in our underlying earnings, this would certainly start to lift those earnings up towards the previous highs that we'd seen in the pre-COVID 2019 year. Now that would position us to be able to consider future dividend increases beyond that point. Of course, outcomes across 24 and 25 are going to be dependent on economic conditions as they develop across that time.
And Will, in a softer year for the Australian share market, Whitefield's total investment return amounted to minus 2.9% for the year to March 2023. Can you comment on this outcome?
With the Reserve Bank's official interest rate target rising from 0.1% to 3.85% across the year, equity returns in Australia and globally were below long-term averages. Whitefield's return was similar to its ASX 200 Industrials benchmark of minus 2.8% for the 12 months. Looking at the longer term, Whitefield's portfolio return over the 40 years to March 2023 sits at just over 12% per annum. And if we include the value of franking credits, this rises to approximately 14% per annum. Strongest returns for the last year came from technology, including Technology One and WiseTech, smaller healthcare businesses such as Telix, Pro Medicus and Nanosonics, Medibank, QBE and Suncorp within insurance, and on the broking side, Steadfast and Ausbrokers, and finally Brambles and Amcor within the industrial space.
It's well known the rise in interest rates from historic lows of 0.1% has influenced the market. How do you see this affecting the outcome for equities this financial year?
Well, we expect markets to continue to oscillate between hope and disappointment around the inflation and interest rate outlook across 2023. With energy costs well below levels prior to Russia's invasion of Ukraine and many COVID-related shortages now having eased somewhat, headline inflation is softening. At the same time though, rising wages, economic resilience and ongoing effects of previous quantitative easing mean core inflation may persist longer than many would hope. Australia's economy overall is very strong, which along with persistent core inflation would suggest restrictive monetary policy for some time. However, the RBA is likely to tread carefully given some households and businesses are carrying very high debt levels.
Is this influencing what Whitefield's investing in, Will?
Against this broadly positive backdrop with very specific pockets of risk, we see opportunities in businesses exposed to the more resilient drivers of demand, such as Goodman Group, ResMed, Medibank Private, WiseTech and IDP Education, and also those with strong management, industry position and pricing power, such as Woolworths, Brambles, Spark, Treasury Wines and JB Hi-Fi. In addition, we've seen some analysts become overly pessimistic about the more visible threats, creating opportunities to invest in viable long-term businesses at attractive prices. For example, Stockland, Dexus, Vicinity, Inghams and Metcash.
100 years is a long time through which the companies continue to operate. Angus, are there any lessons that you'd like to share that have been important to Whitefield and its investors across that time?
Firstly, I'd reiterate that at the heart of Whitefield's strategy lies the belief that it's better to generate and compound steady increments of sound return consistently than to chase unsustainably high and risky returns. 100 years certainly reminds us that wealth accumulation is assisted through the generation of solid returns time and time again, not through inconsistency. It's no good just to generate solid returns for 4 years and back that up with a poor year in year 5. So the additional lesson from Whitefield's 100 years of existence that is pertinent to an investor is the significant benefit that can accrue from the longevity and durability of the investment structure itself. So if an investment lasts 100 years, such as Whitefield, the underlying investor has only had to make one correct investment decision across that time, only incurred one set of transaction costs in establishing that investment. Now, in contrast, if we take investments whose suitability is for a shorter period, or where the investment fund or its durability lasts for a lesser period, and let's say 5 years on average, well, over 100 years, an investor would then have had to change their investment 20 times over. Now, that process involves transaction costs of selling or withdrawing an investment, establishing the new investment, taxation costs, costs of research, and even time out of the market that may come at a cost to the investor. So it's certainly worth thinking that once you multiply those costs 20 times over, it could erode a significant percentage of the investor's value.
The last 100 years has been a period of unprecedented change. Has an Australian share portfolio been a good place to invest across that time?
The last 100 years has been characterised by an incredible period of technological advancement, economic growth, and inflation. Notwithstanding those powerful drivers of the economy, markets over that time have also been beset by periodic setbacks. We've seen periods of recession, a depression, political dispute, military conflict, rising interest rates, and changes to regulation and taxation. And indeed, we saw major market collapses in 1929, 1937, 1973, 1987 and 2008. Notwithstanding those challenges, investment in a diversified portfolio of Australian shares has certainly been valuable for investors across those 100 years, and indeed for long periods of time within the 100 years. And the reason for that is that the powerful nature of the economic growth and the financial benefits that stem from that have certainly outweighed the setbacks that periodically but inevitably occur. So Whitefield over that time has been proud to be able to provide our shareholders with exposure to that economic dynamic, and to have done so with a stable and cost-efficient management structure in the background. As we look forward though to 2024 and the 2025 years, we can't predict what's going to happen, but we'll certainly look forward to reporting on our progress to investors as those years unfold.
Thanks, Angus. That brings us to the end of our 100th year update. For more information about Whitefield and our 2023 results, please see our website whitefield.com.au.